Hello and welcome back. After an amazing technological intelligence that we gathered on the industry, now we have somebody who's really very important at the mutual fund level. Yes, the head product management of Reliance Mutual Fund, Mr. ArunS. Welcome, Arun.
Thank you, Saloni.
It's always so nice to have you here in this session.
Thank you.
So, Arun, we've had a very technological ground concept, right? And we've cleared a lot of concepts of ours.
Right.
I would really want to, directly throw something at you, is that many people, many investors, and when we talk about people like us or the seniors or who've been practicing a lot of saving and investment habit, usually get confused with a mutual fund product to a bank product and an insurance product. So we would really want to know what is the product offering by mutual fund industry.
Okay. I thought the awareness levels about mutual fund is significantly picking up, and mutual funds are now becoming a core product in most people's portfolio. In fact, ideally that's how we would like to be, and possibly people know the basics of it. But to the completely uninitiated, who think probably mutual funds and insurance are not different, or how is it different from a bank account and all that, obviously these are very different products.
Very true.
Having said that, mutual fund possibly can be the most simplest products available ever.
Gee.
So essentially what do? You want to invest.
Correct.
So where do you want to invest? You want to put money in stocks, or maybe you want to put money in
Gold.
fixed deposits,
Correct.
right? You want to put
Gold.
money in gold, right? So there are various places that you want to put money into.
Very true.
You may want to also put money into real estate, right? Now, you can do that yourself. Stocks, you can try and identify the best stocks to invest into, right? Maybe one stock, two stock, a portfolio of stocks, you can do that yourself. What's good about it? Obviously, if you get it right, you can make a lot of money. But for you to do that, you will have to invest a lot of your time, efforts. You'll have to put in resources to do that research.
Correct.
To figure out which stocks to buy, when to buy, when
Very
to
true.
sell, and all of that.
Which is very cumbersome.
Very
actually.
cumbersome. Same way, FD. You have different types of FDs. Company, different kind of rated products, and coupons the interest rates could vary. You're not too sure. Would you want to put all your money in one company FD?
Right.
If something goes wrong,
Well,
what
money is
happens?
gone.
Yeah, all your money is gone, right? If you spread it out into 2 or 3 FDs, even then if something goes wrong in 1 or 2 companies, that could be an issue, right? So you need to invest into these underlying securities, stocks or FD like products, or even gold, right? Instead of you doing that yourself, mutual funds are very simple. You give that money. Let's say you give, there is another investor who gives money. We pool the whole thing and we invest into the underlying markets. So if it is a equity product, we invest into stocks. If it is a fixed income product, we invest into fixed income securities. If it is a gold fund, we will invest in actual physical gold,
Right.
and give you the units
Returns and units. Perfect.
in a paper form. Thereby, you need not worry about physically holding gold.
And the safety aspect.
Safety, storage,
Correct.
purity aspect of it, none of that, right? So it becomes very convenient in that sense. And there are several advantages to doing it this manner. One of them is, instead of you buying 1 or 2 stocks, here you're diversifying. Because I'm not just going to buy with the 10,000 rupees you have
Right.
given.
Correct.
Maybe there are 100 other investors. Somebody has invested 1 crore, somebody has invested 1 lakh, somebody is investing month on month. So I'm going to take the whole amount and use that to buy probably 30 stocks, 40 stocks. So you're getting a diversified portfolio across sectors, across stock, and thereby the benefit of that, even for a 500 rupee investment, right, a systematic 500 rupee investment, you will end up getting probably the best of the markets.
Yes, actually.
Right? And obviously, if you have to do that yourself, you will have to invest your own time, your own resources, etc. You may be a professional, you may not have time to do that. Whereas when it comes to mutual fund, there is, We would like to think of ourselves as experts, but at least we may be better off in terms of dedicating that much time and resources to do the research and be in a position to possibly identify the best opportunities available in the market. Same way, when it comes to debt, there are different types of debt securities, government securities, different types of corporate bonds, different types of debt securities itself, commercial paper, NCDs, and so many other things.
Correct.
And they come in different forms and formats. A retail investor, a small-time investor, you cannot do that.
Absolutely.
So if you want to invest into debt, there are mutual funds. Of course, there are subtle variations within each of them. But then basically it is as simple as that. You give money, we invest, whatever return comes, we pass it back to you after certain administrative expenses and other things. As simple as that.
So it's like my X amount can buy just A, B and C, but when my X goes to you and you pool it with others, we get a complete A to Z thing, and which actually, when you told about getting a diversified portfolio, is something that retail investors are quite little, not very, it's going to be very cumbersome for us, because doing all the study, and then I don't know how much am I right, with my pardoning the limited knowledge to retail investors. I'm sure your efforts are something that we should bank on. So when you say that on a click of money, when I transfer it to you, then it's like my baby is all yours. You are taking care of all the money, and you make sure that the investors actually have a wealth creation with happiness on a note. So you spoke about equity and you spoke about fixed income. There's also one more category, if I'm not mistaken, about ETFs, which is usually a passive category. So as an investor, if I'm an investor, what are the kind of outlook that I should have towards an equity portfolio, towards a fixed income portfolio, and towards an ETF investment?
Okay, see, first of all, ETF is not a separate category of mutual fund.
Okay.
It is a mutual fund, right?
Sure.
The only difference is, when I talked about other funds, these are actively managed funds.
Very true.
Which means that the fund manager takes a call. He takes a calculated call on which stocks to buy, which not to buy, when to buy, etc., etc. Whereas when it comes to ETF, there is an underlying index, and this fund will replicate that index. Which means that if you want to invest into Nifty, as an investor, you're saying that I want to invest into the market and gain from it. I do not want to do anything beyond that. While I mentioned to you the advantages of fund manager picking up,
Correct.
and managing your portfolio actively, it could quite be possible that there could be mistakes as well, right?
Very true.
So when you're seeking higher return, so can be the risk, right?
Very true.
At least theoretically. While the track record has been that funds have given fairly good returns and all that. But there could be a set of investors who might say that I just want to take exposure to the market, right? Nothing beyond that.
Absolutely.
So you have a fund called, let's say, a Nifty ETF, right? It will replicate Nifty. Nifty consists of 50 stocks, and a stock A has a 6% weightage, a stock B has 5.2% weightage. It will replicate to the toe. And what you will get is the exact return of Nifty, of course, minus expenses and all that. So it becomes a passive mutual fund in that sense, which replicates an index. But again, there can be different types of ETFs. It can be equity ETFs, it can be gold ETFs, it can be fixed income ETFs, which invest into some government securities or a basket of government securities. So those concepts remain. The only difference is the active management vis-a-vis the passive replication of a underlying index.
So I guess this is again an investor perspective. If they want to replicate of an index, basically, so we've created a completely new thing for them.
Yeah, and these are listed on the stock exchange. So just like a stock.
Correct.
So ETF is a basket of stocks, and it is listed in the exchange.
On the exchange.
So when you're buying and selling, so instead of buying one stock and selling one stock,
it's
you're
index that
trading in the portfolio itself.
That's really an amazing concept. So, we spoke about the kind of products that you have and how should one, how does it cater to whichever investor does it want. There's one more hitch an investor always has that we've always heard about, that, people just step back. They're almost at the verge of investing, but they step back that, I can't do lump sum investing. Maybe, my pocket doesn't allow more than 5,000 or not even more than 1,000. I can't invest 1,000, 10,000, 50,000 or a crore. Maybe mutual fund is a big game. But I guess, hardly there's any awareness about there are minimal 500 rupees that you
Yeah.
can start with. So I guess these means are called as SIP, SWP, STP. Can you just throw some light on the same?
Okay, all of what you mentioned are very different, SIP, SWP, STP and all that. So like you pointed out, they're all means of transacting in a mutual fund. A lot of retail investors, they tend to mix these terms up, these jargons and
Exactly, financial
the
jargons.
terms, yeah. So a lot of people think mutual fund is SIP.
Which is
So SIP is systematic investment plan, which is nothing but you choose a fund, whatever fund you want to invest into, equity, debt or whatever it is, and within that there are subtle variations in terms of the funds. You choose a fund, right? Either you can invest right now upfront, which is called the lump sum investment, one-time investment, right? And whenever you feel like investing, you can invest. That's one way. The other way is for salaried employees like you and me, right? So there is a monthly salary that we get.
Correct.
Of course, we have expenses to meet out, all that. So after doing all that, there is a good amount that we want to save, right? And this is a month-on-month requirement that I can save so much, right? So that much I dedicate towards consistent systematic investment into my chosen scheme, systematic investment plan, right? The beauty of this, I've dedicated. I know that I keep getting my salary and I've dedicated a part of that towards investments. It keeps going. I'm not worried about market.
Perfect.
Market might go up, down. I know for sure that I don't know markets,
Correct.
right? And no one knows,
They can't time.
right? It might keep going up and down, but the reason markets, the very fact that it goes up and down and systematic investment allows you to invest at different points in time,
Averages.
you kind of tend to average out your investments and therefore your return tends to be the kind of average return.
Correct. It's not heavy on the
Yeah.
pocket and you're still earning.
Yeah.
That's
On the other hand, a lump sum investment, depending on when you invest, with the benefit of hindsight, right? It could be very good or sometimes it could disappoint if you
Sure.
end up investing at a higher level. So the point is not lump sum versus SIP.
Correct.
A lot of people ask this question: should I invest lump sum or SIP? That's not the right
You can't
question.
do that. Correct.
So these are very different concepts. If I am a salaried employee, I get a regular salary, regular
So
income.
it's inculcating the regular habits.
So it
then.
makes sense to keep
Correct.
investing regularly. On the other hand, if I got my bonus,
It's
right?
ideal money.
so will I? So suppose theoretically, let's say I've got a 1 lakh bonus, right? Now, will I invest 5,000 for 20 months? By
Correct.
that time, if market goes up, you would have lost out.
Very true.
Correct? So you might at best want to invest immediately, right? Or maybe 2 or 3 installments and stay put. Anyway, you know that this is a surplus money that you want to invest for the longer term,
You're right.
and you also understand that anyway you don't know what's going to happen
What's going to happen next?
in the very, very near term,
Very
right?
true.
So that's systematic investment plan. SWP, systematic withdrawal plan, is exactly the opposite of SIP. So as the name itself suggests, I invest, right? I'm not indicating any return, but say I've invested in a fund which I believe can give me 12% return.
Good returns.
Whatever, that's my belief, right? Which means that 1 lakh invested over a 1 year period will become 1,12,000. This is my belief, right?
Yes.
Now the journey could be, because of the markets, it could be kind of going through that volatility up and down. It's not that at the end of 1 month 1 lakh will become 1,01,000, 1,02,000, 3,000. It's not going to happen that way. But I know for sure, maybe over a period of time, I'll get 12% plus return. Correct? Which I'm fairly confident. Now what I do is I invest 1 lakh and opt for a monthly withdrawal at the rate of 1%.
Correct.
Right?
Yes.
So every month, through the withdrawal, which is actually
Redeems.
coming from my own
My
investments,
own
my own
investment. And the
units,
redemptions happen.
as a redemption it comes, my 1,000 rupees keeps coming. So in a year I would have got 12,000, which is a 12% cash flow.
Very good.
Right? Now if my assumption comes true that the fund actually has earned 12% return, which means that 1 lakh would have become 12,000, 1,12,000, and I would have withdrawn 12,000. So my capital is intact.
Correct.
I've withdrawn.
It's untouched and it's safe.
Yeah. So people who require regular income,
Correct.
they could be retirees,
Yes,
they could be, why do you invest in a property?
To get a regular flow of
income, right?
later. Correct.
Rental yields are 1.5%, 2%, 2.5%.
Absolutely.
Then you have to pay maintenance.
And then
There
you
is
have to take
tax.
the headache of the
Yeah.
whoever's staying in there.
Yeah, illiquid, all that. So there is a big section of people who actually want to invest lump sum. I want to invest in a property of 1 crore,
1 crore.
and get maybe
Decent
15,000, 20,000 kind of a monthly
Monthly
rent,
returns, yeah.
which works out to what? 2.5 lakh, which is 2.5%,
That's it.
right? On the other hand, can I not invest 1 crore in a
In
fund?
a fund and have better.
It is not assured. 12% is not assured.
But
10%
still
is not
better,
assured. I don't know.
Good risk returns with safe and like my principal staying intact as you just told.
Yeah. So none of that is assured. Your
Correct.
principal may not.
Everything
But
taken
then
into
that's
consideration.
where you need to take
Your
an
call.
informed decision. You need to make an effort to understand. If you do that, against investing, let's say 1 crore in a property and possibly getting a 2.5% rental yield, can you possibly look at getting 12%, 10%, 5 times more, 6 times more? Is it possible?
Lucrative.
Yeah. So you look at the possibilities, try and understand what these are up to, and try and make an investment decision. And it fulfills your goal of getting that regular income.
Okay.
So this is called SWP, right? Now, what is this STP? Systematic Transfer Plan. Is again very similar to SIP. SIP, you keep money in your bank account and then choose a fund. It will keep moving money in a systematic manner from your bank account into a chosen fund. Systematic Transfer Plan, you keep it in a mutual fund itself. When I'm saying mutual fund, typically very low risk, liquid or anything, where
Correct.
possibly it can give better returns than even savings bank account perhaps, right? So I enjoy that. Probably it's almost as liquid, and I keep transferring money from that into another chosen fund. It could be an equity scheme, it could be a debt scheme. So this is called a systematic transfer plan, which is just a small variation of SIP.
SIP.
So likewise, there are a lot of interesting features and facilities that mutual funds offer. There are features like I can invest, whatever dividends comes,
Correct.
I transfer to another
Reput
plan.
it. Correct, very true.
So in a way it is like I've invested, I'm not
Rein-
letting my capital go, whatever returns come,
Is
I
reinvested.
transfer to another fund. There is a very interesting option called as trigger option. I can set up a trigger in my mutual fund. So I've invested, the moment my return is 10%, I want this money, I want profit booking to happen, I want so much money to move from this scheme to another scheme,
That's brilliant.
right? So likewise, depending on what exactly you want to do, having chosen a fundamental fund, you can use various features like this, SWP, STP,
SIP.
trigger option, right? There is this capital appreciation thing. Whatever is a capital appreciation thing, how much capital appreciation should go? Monthly, how much should get transferred from this to that? All of these are
Taken care.
possible.
Very true. So you explain us the means as well.